Good afternoon, everyone. Thank you for coming out to the presentation, Tips to Improve Your Financial Well-Being. Before we begin, I would like to first recite the land acknowledgement. We acknowledge the Tutelo and Monacan people who are the traditional custodians of the land on which we work and live, and recognize their continuing connection to the land, water, and air that Virginia Tech consumes. We pay respect to the Tutelo and Monacan nations and to their elders past, present, and emerging. We also acknowledge the university's historical ties to the indentured and enslaved whose labors built this institution. We pay respect to these people for their contributions to Virginia Tech. On behalf of the ACE, I would like to thank the co-sponsors for this event, AIICC, BCC, El Centro, and IEC. I have the pleasure of introducing Dr. Travis Mountain, Assistant Professor and Financial Wellbeing Specialist in the Department of Agricultural and Applied Economics. Dr. Mountain, please begin when you're ready.
Thanks, Nina. I really appreciate the invite, the opportunity to speak with all of you about some of these financial topics. One thing I mentioned a few minutes ago before we started, if you have any content areas or any specific questions, feel free to throw those in the chat. I have a bunch of screens up, so I should be able to see them. I see Scott and Liz posted some questions in there. And that will really help kind of drive this, especially when we have a smaller group of people here. If anyone has any questions, feel free to put those in the chat as well, or just, chime in, unmute yourself and chime in. Here are some of the topics that I wanted to cover. And again, if there's something that I wasn't planning on covering, feel free to let me know. But just talk about some of your financial goals. So Liz said she was interested in retirement planning, so we are going to talk a bit about that. Talk about some strategies of how to actually reach these goals. I did also want to spend some time on some Virginia Tech employee benefits. So those of you who are employees, just to make sure or to be aware of some of these perks that we have, flexible spending accounts, health savings accounts. Some of them sound very similar, and we may not be sure how to use them or why we would use those. So the first thing that I have here is calculated needs. So this was a survey that came out. They used 2016 data, and this was simply asking people, have you calculated what your retirement needs are? So essentially, how much money do you need to have when you retire? The interesting thing is, for those age 55 and older, only about 3 out of 5 people have actually calculated their retirement needs. If we look at younger groups, we kind of anticipate that we would have lower percentage of those people have calculated their retirement needs. The further we are from retirement, the harder this is going to be, right? When I was 30 years old, trying to think about, well, what is life going to be like when I'm 60? Not as easy as 15 years from now when I'm 55, what is life going to look like when I'm 60? But it is crucial that regardless of your age, you start thinking about this. What are your needs? Because that's going to dictate how much you need to save in order to achieve your goal. Too many times people start working for an employer and they just choose some type of arbitrary dollar amount that they're going to set aside into a retirement account. So maybe they start working somewhere when they're 24 and they decide, 3% of my salary sounds like a good idea. And then they never change that allocation. They keep it at 3% for the rest of their life without determining, hey, maybe I needed to increase that to 10% or to 20%. Or maybe at some point you can actually decrease that percentage. So I do want people to start thinking about what kind of lifestyle do you think you want to have in retirement? So one way to do that is to work backwards. So how much money, and I have in parentheses here, in 2021 dollars, do you want to spend per year in retirement? So I think that's the easiest way to go about doing this. Do you want to be able to spend $40,000 a year, $50,000 a year, $100,000 a year? Whatever dollar amount it is, I mean, it's personal to you. There's no right or wrong answer, but it is some type of benchmark that you want to set. Then you also have to think about how many years before you retire. Are you planning on retiring at 65, 75, 45, right? The shorter time horizon we have, the more aggressive we need to be with our saving. When I say aggressive, the more we need to be contributing towards these retirement accounts. You also have to think about how long will you be in retirement, right? So essentially, how long are you going to be alive? If you retire at age 65, is your life expectancy 90, 95? If you retire at age 50, you still have the same life expectancy, but now you need that money to last decades longer. So that's one of the other variables. How long are we going to be drawing on this money? And then ultimately, that's going to help us determine how much money do I need to save in order to reach this goal. So I have three different sources on here, and I use all of them. So the easiest one potentially is to use an online financial calculator. And there's dozens, if not hundreds, of online financial calculators. I like using the ones on dinkytown.net, and I have that address in the PowerPoint here. But if you go to dinkytown.net, there's probably, I don't know, like 50 different financial calculators, all based on, what you're interested in. So some of them would be retirement planning, what I'm talking about right now. Some of them would be, should I take out a 30-year mortgage on my home, or should I take out a 15-year mortgage? You can look at it to figure out how much interest you're going to pay on a credit card balance if you're only making minimum payments. Like I said, there's 50, 60 different financial calculators that you can use. And you just put in whatever information you want to put in. There's nothing tied to your actual accounts. Mint.com and Personal Capital. So these are two different ones, and I use both of these. Mint.com I've been using, I think, since 2009. So I've been using it for about 12 years. This is a little bit different because this and Personal Capital are going to be linked to your financial accounts, to your banking accounts, your credit card accounts, investment accounts, all those types of things. So when I go to mint.com, if I were to bring that up right now, I have all my financial accounts linked to it. So it would tell me, hey, you have a $500 credit card balance, or you have $10,000 in your investment account. You have a credit card bill due next week, those types of things. So it's good in one sense of, tells me, what is my net worth, which is all my assets subtracted by my liabilities, everything that I know, and I can see what my net worth is. But it also has a goals tab. So I could put in there that, I want to be able to have $500,000 when I retire at age 65, right? So my goal is $500,000 at age 65. And I say, how much money do I have? Like, I link different accounts to it. So maybe I link my Virginia Tech retirement account to it. And let's say I have $10,000 in that retirement account, saying, okay, you have 30 more years to reach this goal. You are going to have to contribute, I don't know what that is off the top of my head, but $500 a month, or $2,000 a month, or $100 a month. But it gives you a good idea of how realistic is this goal, right? If mint.com is telling me $500 a month, can I come up with $500 a month? If I can't, right, there are some things that I'm going to need to change. Maybe I need to lower that $500,000 to $450,000. Or maybe I'm going to say, instead of retiring at age 65, maybe I need to push that back a few years. Maybe I need to retire at age 67. Okay. So again, when we're thinking about working backwards and what our goals are, how much we need to save for that, it's just so we have a decent sense of how realistic is this goal for me, right? So Tyler's goal of maybe having $2 million when he retires, maybe that's going to be realistic for him because he's going to be a super saver, right? But maybe I'm not going to be as much of a saver. Maybe I'm really going to value my current consumption more. I want to have a nicer car. I want to have a nicer house. There's no right or wrong, answer to that, or right or wrong way of thinking about that. It's just a matter of realizing there are trade-offs. Okay, so those are things we need to think about. Personal capital, I don't use that more as a retirement planning tool, but I do use it more as a budgeting tool. So it will show you the budgets, but there is also some nice retirement planning simulations that you can do with personal capital. This is something that I got earlier this week, or I should say earlier this year. I was looking at the personal savings rates, and this is showing us in February 2020, the average savings rate for US households was a little over 8%. In March 2020, it was a little over 12%. And then in April, it skyrocketed up to 33%. So people were saving 33% of the money they were bringing in. Why were they saving so much money? Well, a lot of that coincides with stimulus payments that people were receiving, right? So families were receiving thousands of dollars in stimulus payments. And one thing that we were doing like a year ago when we were doing this type of education is letting people know, hey, like you have all this money, but you need to save it because we're not sure how long COVID-19 and the negative financial ramifications are going to last. So, not just us, but a lot of educators were saying that type of thing. So savings rates reach an all-time high of 33%. If we look historically, we've never had anything anywhere near that close. We've seen something over 15% before I was born in the 70s. The most recent numbers that I saw have shown that savings rates have dipped down to about 13%. But again, I want to make it clear that we shouldn't just have these arbitrary savings percentages. A lot of times, if you just Google or do an internet search for how much should I be saving for retirement, 10% is something that often comes up. But 10% might be great for Nina, but maybe for me, 10% isn't going to allow me to reach my goals. So again, I want to make sure that we're calculating what our actual need is. This is a chart that I have. I realize it's not the best chart, but a presentation I did last month for Hokie Wellness, I had some Zoom poll questions. And the poll question was, in 2020, did the stock market increase, decrease, or have absolutely no change? And about 50% of the people who were in attendance said that the stock market went down in 2020. Actually, the stock market overall had one of its best performing years. So the stock market over 2020 was up about 16%. So this is tracking the 500 largest companies traded in the United States. A lot of people focus on this big dip that we had in March. So March 23rd, 2020 was the low point. A lot of people, if they looked at their retirement accounts or they looked at their investment accounts, they might have been down around 30%. So for easy math, in February, maybe you were sitting on $100,000 in your retirement account. March 23rd, you look at your balance and you're down to 70%. So that was very dramatic downturn in a very short period of time. A lot of people panicked. Unfortunately, I mean, I'm still waiting on the data for this, but I suspect a lot of people sold out their assets. So maybe they're invested in like an S&P 500 index fund, which is a mutual fund that tracks the 500 largest companies. So many people may have sold out of that. So they sold out, let's use the same example, they're $70,000 and they put it into cash. Well, unfortunately, if they did that, they were probably earning very close to 0% on their money, and they missed out on this tremendous gain, okay? In general, people who do this are trying to time the market, and in general, people do extremely poorly at timing the market. Ideally, if you're going to try to time the market, you would sell when stock prices are high, and you would buy when stock prices are low. But research has routinely shown that we do the exact opposite, right? People sell at this point when it's low. Instead, if I was going to do market timing, I would have sold in February, right? And then I would have bought all of this back in March. But it's impossible for anyone to be able to predict, when the peak is going to be, when the trough is going to be. Research has pretty consistently shown that just leave your money in the market, right? If you're invested in the market, because over time, there's no guarantee that future performance is going to be the same as past performance, but over time, the stock market has always increased. This next graph is looking at the Dow Jones. So this is the 30 largest companies. And I just did a reference point of 2004 because that's when I started investing. It was 2003 or 2004 when I was a junior as an undergraduate. As a junior. So here we see 2004, right? So the stock market, it's doing all right, it's going up. And then what did we have? We had the Great Recession. So this is that shaded gray area. So we had the Great Recession. So stock market went down 40, 50% for a lot of people. A lot of people, again, sold at this down point and they never got back in the market, and they've missed out on one of the largest bull markets in the world, and like the largest bull market that we've seen in the United States. And bull market just means, impressive positive returns for an extended period of time. And the reason why I think that this is so interesting is because This other shaded area here is what we saw in March of 2020. In a short period of time, that was such a dramatic downturn, but in the grand scheme of things, it's just a tiny blip, right? If I'm investing for 20, 30, 40, 50 years, right, what happened in March isn't that devastating for me. That's why whenever we're talking about investing in the stock market, we're investing in the stock market for long-term goals, okay? So if your retirement's 10 plus years away, investing in the stock market makes sense. If you are saving money for a down payment on your home, and you're going to be buying that home, in the next couple of years, you do not want to be invested in the stock market, because if you need $50,000 for your down payment, right, there's a decent chance that the stock market is going to go down this year. So you can't afford to take that chance. On average, the stock market has a negative rate of return about once every 3 years. So out of 3 years, 2 years, we anticipate it being positive. 1 year, we anticipate it being negative. So like my wife and I have money saved for a down payment. We have that money sitting in an interest earning savings account that's earning only 0.4%. So a very low interest rate. It's painful to see that it's such a low interest rate, but we can't afford to lose that money. The money that we have invested for our retirement, which is decades away, that's the money that we have in the stock market. Again, if anyone has any questions, feel free to throw those out. So we talked a bit about the stock market. We talked a bit about working backwards. There is an extension publication that I co-authored. You can search that on Virginia Tech's website, but it's called How to Make Your Money Go Further. It talks about getting organized. It talks about setting your goals. It talks about creating a spending plan in order for you to try to figure out, how am I able to get to this $500? If it's a retirement goal, or if it's debt pay down, how am I able to pay down some of that debt? But a really important starting point here is a spending plan, or oftentimes it's referred to as a budget, but for a lot of people, budget has a negative connotation. So to create this spending plan, one thing that I have my undergraduate students is track their expenses, and I have them track their expenses for 30 consecutive days. So if they go to Chipotle for lunch today, they write down that they spent $9 at Chipotle. If they go and pay their rent on the first of the month and they pay $700, they write that down. In general, households in the United States have a pretty poor grasp of how much money they are spending, right? Most people have a really good sense of how much money they're bringing in because maybe they get paid every 2 weeks. So they have a good sense of that, but they really are not sure how much money they have or how much money that they're spending. And the problem with that is it's really hard for me to, one, achieve my financial goals, right? Because if I know I'm making $3,000 a month, but I have no idea how much I'm spending every month, I don't know if I have $200 to save for retirement, or I don't know if I have $200 to save for that down payment on my house. So I don't want to spend too much time talking about spending plans, but really I do, stress to people, if you're not sure how much that you're spending, do track this, like do it for a month. Most of my students are really surprised at some of their larger categories. They know that they're eating out. I mean, COVID's a little bit different, but they know that they're eating out, but they're shocked as to how much money they're spending eating out, right? And it's not that spending money on eating out is bad. I mean, I have no judgment on it. It's just the individual needs to decide, is that dollar amount appropriate for me reaching my goals? Maybe it is, maybe it isn't. That's kind of the purpose of this, right? You have a fixed amount of money that you're bringing in every month. What is the best use of that money? Do I want to spend that extra money on dining out? Do I want to spend that extra money on a nicer home? Do I want to spend that extra money on some type of future goal? That's basically the decision that people need to make for themselves. All right, so kind of jumping around a little bit. How many people, well, I guess it's kind of hard to tell, but I hope people have checked their credit report. If you haven't checked your credit report, here's a really short PSA. Go to annualcreditreport.com. Oops. Go to annualcreditreport.com to check your credit report. Usually you can check each of your 3 main credit reporting agencies. So in the United States, we have Equifax, Experian, and TransUnion. Typically you can do each of those once per year, but currently through April 2021, you can do each of those once per week. Okay, and this is not going to negatively affect your credit score by you going to annualcreditreport.com and checking your credit report. Things that you're really looking for when you check your credit report are just to make sure that everything that is on there are things that you recognize, right? You want to make sure that if you have 2 credit cards, that there's not like a third credit card that's showing up. Or you want to make sure that there isn't late payments that are reported if you haven't had any late payments. This is really important for anybody who may have like a forbearance on their student loans, people who may have a forbearance on their mortgage. They want to make sure that those are being reported correctly. If I have any type of forbearance on either my mortgage or my student loans, it should be reported as being paid as agreed. Okay, that is not going to negatively or positively affect my credit report. But if it is mistakenly being reported as late, that is going to negatively affect your credit score. So really, those are kind of the big things that you want to look for. Here's some information for credit card by the number. So I have some data here that I pulled from some national databases. The data is a little bit old. Some of the numbers are from 2016. Some of the numbers are from 2018. But in general, the same story is true. About 3 out of 4 consumers have at least 1 credit card, and most people who have a credit card have 2 credit cards. We have 2 different terms here. So revolvers are those who do not pay credit card balance in full every month. So they represent about 44% of the US households. So every month they are carrying a balance. So a little bit more than half of households are convenience users. So those are people who are charging, their Amazon, their Netflix, their groceries, all that. And then every month they're paying that balance in full. Okay. Now, if I am paying my balance in full, I just want to make sure everyone's aware that you don't pay any interest then on those charges. So anytime that I'm able to use a credit card or a debit card or cash or check, I always choose my credit card. But I'm a convenience user. I pay off my balance in full every month. So I pay no interest, but I'm getting back rewards, points, or cash back, those types of things. Depending on the source, the average balance of those people who have credit card balances is between $5,000 and about $6,500. So I just picked a midpoint. I said, if they're only making the minimum payment on a $6,000 balance, it's going to take them 12 years to pay off. And they're going to pay almost $4,000 in interest. So again, if you do have credit card balance, that's going to be one of the first things that you want to try to prioritize of paying down. Most people's interest rate on their credit cards is going to be like in the low 20s. So low 20s is a really high interest rate. Historically, the stock market, for comparison, has returned about 10%. I have some things a little bit later on mortgage rates. Mortgage rates are a little lower than 3%. So if you are paying credit card interest at 21, 24%, that is extremely high. That would be my first priority, is paying down that credit card interest. Just a few slides on stimulus payments. There still seems to be quite a bit of confusion. So this slide, I'm talking about the first 2 rounds of payments that we received. So round 1 was in the spring of 2020. Round 2, most of us received January 2021. The biggest takeaway from this is that it's a 2020 tax credit. We do not pay any taxes on this money. So like my family in January received $1,800, $600 for me, $600 for my wife, $600 for my son. I just filed our taxes earlier this week, and I had to report, yes, we did receive these economic income payments. They said, okay, great. Looks like you received the amount that you should have received, and you do not pay any taxes on this, okay? It's possible, and very likely it seems like, that we are going to receive a 3rd round of stimulus payments, but I have with exclamation points and in parentheses, this is not final. All this could change. It looks like the way that this is going to work, though, is that we could anticipate receiving $1,400 per person. So if you receive round 1 of stimulus, round 2 of stimulus, you're likely to receive round 3 of stimulus. That would be $1,400. So then a family of 3 could expect about $4,200. This is going to be a 2021 tax credit. But again, this is not going to be taxable. This isn't something that you have to pay back. Okay. It also looks like this one is going to be a little bit better in a sense that it will give money to college students. So in the past, you had to be under age 17 in order to be considered a child dependent in order to be eligible to receive this. But it looks like it's going to be extended to college students as well. So in round one and round two, if somebody had like a 21-year-old child who was a college student, they did not receive any of the stimulus, but it looks like round three is going to pay them that stimulus. Of course, that stimulus is going to go to the parents, so it'd be up to that college student to decide, if I should get that or if the parent should get it. The phase outs are going to start around $75,000 of income for an individual or $150,000 income for a married household. So there is a question here, what about recent graduates? For example, 2020 graduates who are listed as dependents. Yeah, so, I'm going to be speculating, but my sense is that this is going to get paid out probably in March 2021. And what they're going to be using is 2020, either 2020 or 2021 tax year. So if this is a situation where we have somebody who's graduating in 2020, if they look at their 2020 taxes, it is going to report that they had a dependent student who was a college student. So that person then would be eligible for this stimulus payment. If that same household decided to do their taxes just like I did in February, and I no longer am able to say that I have a dependent child because they already graduated from college, then that household is unlikely to receive that stimulus payment. So that's actually a really good question. If I'm in that situation, I may actually be motivated to delay filing my taxes until after this is figured out. I may want to wait. The deadline's April 15th. May want to wait until after March when seemingly this has been resolved. That's a really good question. But again, I do want to make it clear that this is being recorded next week. All of this could change because Congress changes things all the time. So there's a lot of variability here. What about student loans? So anyone who currently has student loans, and I've just been using this exact same slide for over a year. So that's why I put all these red crossouts just for us to see how many times this has been extended. Originally, the forbearance was for March 13th, 2020, then it went to September 2020. Now it is pushed back until September 30th, 2021. So if I have a federal student loan, I do not have to make payments until September 30th, 2021, and there is no interest that is going to accrue on that. So if my student loan balance is $10,000, and it's in a forbearance and I don't have to start making payments until later this year, once I start making those payments, the balance is still going to be that $10,000. It's not going to go up. So really people can think about, well, what happens if you have some money? Is it worth you paying down your student loan balance? Is it worth you investing? It's really not possible without knowing a lot of information for me to actually give you any type of advice. For my personal situation, if I had student loans, I wouldn't be too eager to pay those off at 0% interest rates. If I had the money to pay them off, I would just be accumulating that like in a savings account, earning a very low interest rate to try to figure out what happens if there is any student loan debt forgiveness. It looks like, but again, this could change, next week, it could change later today. But it looks like there will be student loan debt forgiveness. It looks like the most likely outcome is $10,000. That's the dollar amount that President Biden seems to be sticking to. There are some Democrats that are pushing for $50,000, but as of right now, that looks unlikely. So let's just assume that $10,000 is forgiven. So go back to the example where I had $10,000 right now. It's accumulating zero interest, so essentially 0% interest rate. If I have the $10,000 and I pay that off today, right? And then 6 months from now, it comes out that there's going to be student loan forgiveness of $10,000. I'm not getting that $10,000 back, right? At least I'm assuming I'm not getting that $10,000 back. That's why, again, I wouldn't really be too eager in paying this off. Even if there wasn't this potential debt forgiveness, I'm never really too eager about paying off interest at 0%. But let's say that, again, there is that $10,000 debt forgiveness. What happens? Well, usually if there is debt forgiveness, that would be a taxable event, okay? So if I have debt that is forgiven of $10,000, I don't pay that $10,000 back, but when I file my taxes, so when I filed my taxes in April 2022 for the 2021 tax year, I would be getting a form that says $10,000 in student debt was forgiven. In that case, I would have to pay taxes on that $10,000. If I'm in the 22% tax bracket, so for me, that would mean I would have to pay $2,200 in taxes on this forgiveness. So it's good in one sense that I don't have to pay this $10,000. It's bad in another sense of, well, that $10,000 was going to be paid off potentially 10 years, potentially 20 years, but this $2,200 needs to be paid back by April, okay? Now, there's no guarantee that Congress or President Biden is going to say this is taxable. In general, the default rule would be that it is taxable, but there's nothing preventing Congress or President Biden from saying this is not going to be taxable. The PPP loans that were given to businesses that were adversely affected due to COVID-19, those people who received the PPP loans, a lot of them had their debt forgiven and they did not have to pay taxes on it. So there is precedence here for not having a taxable event. Okay. Okay, so I see Sally sent me a question, and Sally, we will get to that, okay? Okay, one thing I do also want to talk about is what about refinancing your mortgage? So let's say that I'm in a pretty good financial position right now, and I'm thinking about refinancing my mortgage. So here I have a screenshot, just looking at Freddie Mac's webpage. It goes back to the 70s at some point, looking at mortgage rates. So we see in the 80s, we had really high inflation and mortgage rates were over 15%, but they have been going down dramatically since then. So January, like a month ago, the interest rates, if I wanted to get a 30-year mortgage, which is the most common type of mortgage in the United States, was about 2.8%. So really low. So I've been getting a lot of questions from people, and they say, you know, should I be refinancing? I took out this mortgage 5 years ago. I took out this mortgage 10 years ago. What should I do with that? So here I made an example. So I moved to Blacksburg to take this job at Virginia Tech in 2015. So let's just assume that I took out a $200,000 30-year mortgage in 2015. And early 2015, the interest rates were 4%. My monthly mortgage payment would be about $950. 6 years later, so early 2021, my balance would be about $176,000. So now I was paying 4%. Let's consider refinancing. If I refinance that remaining balance of $176,000, but I'm able to get this 2.79%, my monthly mortgage payment goes from about $950 to about $725. That's a monthly difference of $230 that I could be saving. Now, if I go to my bank and say I want to refinance, they're not going to do it for free, okay? So that is something you want to look into. Just because your interest rate went down, don't think, oh, I'm automatically going to refinance. You'd want to contact your financial institution, say, hey, if I do refinance, how expensive is this going to be? A lot of refinance ends up costing about 3% of the mortgage, but there's a lot of variables involved there. So I just use 3% for an example. It would take us about 23 months for us to break even. So if I knew I was going to be in this house for another, 10 years, I mean, it makes sense for me to refinance. If I'm only going to be in this house for another 2 years, maybe I'm going to graduate, or maybe I'm anticipating retiring or just moving to a different part of the world, refinancing wouldn't make sense, right? Because yes, I'm going to save $230, but it's going to cost me more to do that than I would save. Here's another example. So mortgage rates, right? They've been going down. So what if we took out the same $200,000 mortgage, but instead we took it out in 2011 when interest rates were 5%? My monthly mortgage payment would be almost $1,100. 10 years later, I would owe about $163,000. I'm thinking about refinancing right now. My mortgage payment would go from about $1,100 down to about $670. So now we have a monthly difference of about $400. It would only take me about 12 months to break even, right? So if I'm planning on being on that house for a long time, or at least longer than 12 months, it would make sense for me to refinance. Okay, I'm going to go through this one kind of quickly, I think, because I do want to get to some retirement information here. But really, the talk about this is going to be health FSA and HSAs. So an FSA is a flexible spending account. An HSA is a health savings account. These are two different accounts for health-related expenses. So for the health flexible spending account, I can contribute $2,750 to this health FSA. And it's a program that you would register for through Virginia Tech. It would be money that is deducted from your paycheck, and that's put into this FSA account. $2,750 is the maximum amount that I could contribute. It's only used for medical expenses. And I have this underlined. It is a use it or lose it plan. So if I decide that I'm going to put $2,000 into this account and I only have $1,000 in medical expenses, the remaining $1,000, essentially, I just donated that to Virginia Tech. Okay. A health savings account, the maximum contribution, if I'm an individual, is $3,600, or if I have a family plan, it would be $7,200. In order to be eligible for this health savings account, you must have a high deductible health insurance plan. So high deductible plans would mean there's a lot of out-of-pocket expenses for you before your insurance starts kicking in. Okay. So for an individual, the minimum is that your deductible has to be $1,400, or if I'm married, my deductible needs to be $1,800. My first couple of years at Virginia Tech, I had a high deductible health insurance plan. I was single. I don't use healthcare all that often. So the high deductible plan just made sense for me. So I had a health savings account for my first several years at Virginia Tech. I want to say my deductible was maybe about $1,500. So I had a lot of out-of-pocket expenses before my insurance would really start kicking in. A nice thing about a health savings account is this is not a use it or lose it plan. So if I contribute $2,000 in 2021 and I don't use it at all, there's no penalty. That money can stay in my health savings account until I decide to take it out. So this academic year, I am not eligible to contribute to a health savings account because I now am on a family plan and we do not have a high deductible health insurance plan. So I'm not eligible to contribute money to my health savings account. However, I have about $20,000 that's in my health savings account. Did I contribute $20,000? No, I didn't contribute $20,000, but I haven't invested in the stock market, and it's grown from like $12,000 to $20,000. I can use this for health-related expenses, but really I plan on using that money in retirement. There's no end date of when I can use this money. Let's say, for example, though, next year I have like a $2,000 medical expense. If I wanted to, I could take that $2,000 out of my HSA. But again, my plan is just to keep it in that account and then take it out in retirement when I think I will need it more. I'm going to skip through some of this child stuff because I'm not sure how relevant it is. But I do want to talk a bit about retirement because I have been receiving some private questions, and then I'll go through and try to catch some of the other questions that I missed. Okay, university employees. So us at Virginia Tech are university employees. We're in a unique situation where we have access to both a 403B plan and a 457 plan. Okay. The real advantage to this is, and I'm not exactly sure why, I don't know if it's a loophole, but why this exists, is that we are able to contribute to both of these plans. So in 2021, the maximum contribution to each plan is $19,500, meaning we can contribute $39,000 in total. You can contribute $19,500 to your 457 plan. You can contribute $19,500 to your 403B plan. If, let's say, we weren't working at Virginia Tech and we decided to go the private industry route or the for-profit route, maybe I should say, and they offered a 401k plan, we would be able to contribute $19,500. So the same amount as a 403b plan or 457 plan. So the real advantage here, working for a advantage of this is that if you have the income or you have the means of doing this, you could contribute to both. Okay, so just to kind of go through what these numbers would look like. So we save a large percentage of our income. So we save a lot for retirement in the future. We value our future consumption a lot more than we value our current consumption. So I max out both my 403b plan and my 457 plan. So in 2020, that was $39,000. So it is a lot of money, but really the point of this I want to show you is how much is this truly costing me? So the $39,000 that I contribute, it lowers my taxable income. It's a deduction on my income. So when I file my taxes, let's just say for simple math that I made $100,000 at Virginia Tech last year. When I'm doing my taxes, it's going to show up as if I made $61,000. So it reduced my income by $39,000. I'm in the 22% federal tax bracket, and I pay about 5% to the Commonwealth of Virginia. So by contributing this money towards my retirement account, I save a little over $10,000 in taxes. Okay, so that's the real advantage in me saving in like a 403b plan and a 457 plan. The traditional type of options is current tax savings, right? Now, if people have questions about, well, what would I choose between a traditional versus a Roth? Really, the decision there is, when do you think you're going to be in a higher tax bracket? So this example that I have here is a traditional 403b plan, a traditional 457 plan, which means I get the tax benefits today. I think that I'm in a higher tax bracket now than I will be when I take money out in retirement. Okay, but when I started investing in 2004, I knew that I was in a really low income tax bracket. I mean, I only made a couple $1,000s as an undergraduate. So I knew that my tax rate in 2004 was probably the lowest it's ever going to be. So in 2004, I did not choose the traditional option for an IRA, which we haven't gone to yet. I chose the Roth option, which means I received no tax benefits in the year I contributed, but when I take the money out, I pay absolutely no taxes. Okay. So right now at Virginia Tech, if you choose to do a 403b plan, you could choose a Roth option. If you chose that, you get no tax benefits today, but when you take the money out in the future, you pay no taxes on it. Or you could choose the traditional option, which means you get the tax benefits today, which, in this example, I saved $10,000. But when I take the money out, it's going to be treated as regular income, and regular income you pay taxes on. Okay. If I only was going to choose the 403b plan or the 457 plan, I would choose the 457 plan. And the reason for that is when my time with VT comes to an end. So for whatever reason, I'm no longer an employee at Virginia Tech, I can withdraw money from this account with no penalty. So let's just say for simplicity that it's $10,000, and I, after I'm no longer working for Virginia Tech, I take that $10,000 out. I will have to treat that as income, but there's no penalty on that. If instead that same $10,000 was in my 403b plan, and I was younger than age 59 and a half, I would have to pay a 10% penalty on that $10,000, plus I would have to pay taxes on it. So financial independence, retirement early is something that maybe people are familiar with. The FIRE movement, if you do an internet search, it's talking about, how can I retire in my 30s? How could I retire in my 40s? How could I retire in my 50s? Right before the traditional retirement age. if you're thinking about that, or you're thinking, hey, retiring at 50 sounds great, and you were choosing between the 403B plan or the 457 plan, the 457 plan would be ideal for that person, right? Because they're retiring at, let's say, 50, right? They can take that money out. They won't pay the 10% penalty. If instead they chose the 403B plan and they needed that money, they would pay a 10% penalty on that money. Okay. I'm just going to go back. Harissa, can you, in that case, why would you use your health FSA if you do have a high deductible health insurance plan? So are you talking about the health HSA?
Yes.
Okay, why would you use, are you saying why wouldn't I use it?
When you were like referring to the benefits of like not the health savings account, saying that you can roll it over, I'm just wondering then why would FSA then be advantageous, since it's a use it or lose it? It seems
Yeah.
like if you do have a high deductible health plan, like HSAs are the way to go.
So if you have a high deductible if you have a high deductible health insurance plan, you're not going to be able to choose the FSA. It's going to be an HSA or nothing. So yeah,
Okay.
you're absolutely right. I'm not going to be in a situation where I get to pick which one I want to do, because you're right, the HSA is always preferable, but HSA is only available to those who have the high deductible plan. So currently, my family is not in a high deductible plan. So we do the FSA only because we're not eligible for the HSA. If we were eligible for the HSA, like if we could do an HSA with a non-high deductible plan, we would 100% be doing the HSA. You're exactly right. Yeah, I should have made that clearer. Any other
Thanks.
questions on that?
Oh, I had a question. You
Sure.
mentioned that you put your HSA in the market. How did you do that? Because I think I had an HSA at my last institution, but I don't remember having the option to put it in the market.
Yeah, so let me just back up for a second. So with the flexible spending account, you do not have the option of putting in the market. So if I go and open up an FSA as a Virginia Tech employee, that I'm doing directly through Virginia Tech. So you are not going to have that money invested in the stock market, nor would I advise that money being invested in the stock market, because you need to spend it, use it or lose it. Now with my HSA, which I set up as a Virginia Tech employee, Virginia Tech does not have HSA that I do like through the workplace. I have to go and find my own financial institution where I want to set up this HSA. And if I want to contribute like $2,000 to it, I'm doing it outside of Virginia Tech payroll. So it's a completely separate thing. So
Gotcha.
at the time, like I chose Wells Fargo, and then Wells Fargo sold it to some other financial institution, and I didn't like that financial institution, so I transferred it out. And now my HSA is with Fidelity. So Fidelity is one of the largest financial institutions. They have really low fees. So with my HSA with Fidelity, I could keep it like essentially in a checking account earning 0%, or I could choose to have it in an investment account. It's still a HSA, but I can choose where I want to put that money. And because I'm not planning on spending that money anytime soon, I can afford to take the risks of, the stock market going down 50%.
Okay, so in addition to my FSA, I should maybe consider getting a separate HSA, because I hadn't considered using that for retirement.
Well, so, it just depends on the actual timelines there. So, if you have so do you have an HSA from a former employer?
No, I depleted that before I left, and so I
Okay.
don't currently have any HSAs. I just have the Virginia Tech FSA.
Okay, so then if you do not have a high deductible health insurance plan, you cannot contribute to an HSA. So I can't contribute to both. So if I
Okay.
contribute to both, when I do my taxes, a red flag is going to go up and I'm going to have to pay a penalty, and I'm going to have to pay that money back.
Okay, gotcha. Thank you.
Mhm. I did briefly, so we only have a few minutes. I did briefly just want to talk about IRA plans. So in IRAs, an individual retirement account, and especially those of us right now who are maybe undergraduate or graduate students, you're not fully employed, but you're interested in investing in the stock market. This is exactly what I did as an undergraduate. I went to Vanguard.com, but you could also, like I mentioned, Fidelity. You could go to any large financial institution. You can open up an individual retirement account. The only requirements is that you have earned income. So I think maybe my junior year, I only made $2,000. So the maximum I could contribute to my IRA is $2,000. Okay. Now I make more than $2,000, but still the maximum I can contribute is $6,000. So in 2020, it was 6,000. 2021, it's also 6,000. Those of us who are 50 and older, you get like a bump up where you can contribute an extra $1,000 up to $7,000. So if you don't have a workplace option, or you do have a workplace option, but you're maxing out all those, I would look into an IRA, individual retirement arrangement, or individual retirement accounts. Okay, so now I think that there's a lot of questions. So as long as you make below the maximum eligible income for Roth IRA, would it be almost always advantage to opt for Roth versus the other options? Yeah, I mean, essentially, yeah, I think if I'm understanding your question correctly, it really all comes down to your tax rate, right? And it's impossible for me to know with certainty what my tax rate is going to be in retirement, but I feel like it's going to be less than 22%. In 2004, I was in the 10% tax rate. So there was like 99% confidence that in retirement, I was going to be in a lower tax rate. So, you know, if you do have low income, but you're going to always have low income, right? Then it's not as clear cut that the Roth IRA is better for you. And while I'm talking, I'll just put some of these differences on here. Here's a question. What are the lists of costs associated with refinancing? Do you have to get your house appraised? Yeah, so you need to get your house appraised. So there's going to be costs with that. The financial institution, you know, a lot of the same costs that I would need to pay, you know, getting my first mortgage, I'm going to have to pay when I'm doing refinances, when I'm doing a refinance. There is an option with Virginia Tech employee benefits, legal services. I pay something like $7.50 a paycheck to have legal services. So if I do ever buy a house, which we've been saving for, but house prices have been appreciating faster than my savings rate, it seems like, you know, the legal services could save us a couple $100 or maybe $1,000 there. So legal services is something to look into. But yeah, all the same type of fees that I would pay for a primary mortgage or my first mortgage, a lot of those are going to be similar. Okay, so let's see here. So for money going forward in retirement, if I wanted to add money to a retirement account, is there a difference between adding money to a mutual fund IRA or increasing the amount going into BT's 403B plan? Okay, so that's a really good question. Really it comes down to, hey, where should I be putting this money? You know, I decide I want to save $3,000 a year. Should I put it towards, you know, a 403B plan, a 457 plan, or an individual retirement account? Keep in mind that if you're contributing to either your 403B plan or your 457 plan, as long as you're contributing a minimum of $40 to one of those, Virginia Tech has like a cash match program. So they're giving you a free $20. It doesn't sound like a lot, but it's a 50%, you know, rate of return, free money. So I'd make sure that I'm contributing at least $40 to the 403B plan. And then after that, it's a matter of thinking about what are you eligible to contribute to. So if you were to do an internet search for traditional IRA income limitations, like my family, we make too much money to be able to get a deduction on our traditional IRA. So it's not possible for us. So that's why for us, the order of operations would be contribute to the 457 plan, then contribute to the 403B plan. So I get the tax savings. And then after that, we are deciding between, are we going to do a Roth IRA or are we going to do just a traditional brokerage account? If I wasn't working at Virginia Tech, usually the order of operations would be contribute to your 401k plan if you're working for a for-profit company until you're getting that company match. Make sure you're at least getting that company match. And then after that, decide, is an IRA better? And an IRA may be better because a lot of employers don't have really good 401k plan options. There's an index fund in our 403b plan, which has really low fees. So that's where all of my 403b money goes. All of my 457 plan money also goes into the index fund just because it's really low fees. But like when I was looking at my parents' 401k plan like 10 years ago, I mean, they had terrible options, really expensive fees, high fees. So in that situation, it didn't make sense for them to put a lot of money in their 401k plan. It made more sense for them to go into an IRA where they could choose like a Vanguard or a Fidelity, something like that. I saw Scott's question. I forgot about it. Should I pay my house off early or invest elsewhere? So I have a research paper and we were looking at this a little bit. The average house in the United States appreciates at around 2% a year. Now, there's obviously, I read something that from 2019, the end of 2019 to the end of 2020, the average home price appreciated by 10%. And also in different parts of the country, house appreciation is going to be different. But on the whole, houses appreciated about 2% per year. The stock market appreciates about 10% per year. Now, I have no guarantee what's going to happen over the next 5, 10, 20, 30 years. But in general, from a financial standpoint, you would be wise to invest elsewhere. Now, from a psychological standpoint, being debt-free has a lot of value to it as well, right? I mean, I've talked to a lot of people who have paid off their debt, and the freedom that they associate with that, you really can't quantify, or at least, I can quantify. So that's something to think about. If you have an interest rate that's at like 2.7%, personally, I'm not in any real big hurry to pay that off, and anytime soon. Also, you want to think about where you are in your mortgage. If you have like 7 years to go in your mortgage, almost all of your mortgage payment, or a big percentage of it, is going towards your principal. You're paying very little interest. If you're in the first 5 years of your mortgage, you're paying a lot of money towards interest. So that may also sway you. The later I am in the mortgage, the less motivated I am to pay that off.
And just kind of a quick note on mortgages and home financing. You mentioned that there's like a lot of costs associated with refinancing. What are some of those costs? Like I heard that you have to get your house appraised again. And like what else would you have to plan to pay for?
Yeah, so if I go to my financial institution, they're not going to do it for free. So it's going to take them time. They're going to have to push paperwork. That's going to be one of the biggest expenses for the refinancing. Is let's just say I'm doing this with Wells Fargo, for instance, and I'm going to lower my interest rate from 5% down to 2.5%, and maybe I'm going to save $500 a month. That's less money that Wells Fargo is going to receive, right? So they're not extremely motivated to make that happen, and that's why they're charging a fee to kind of process some of this paperwork.
Thanks.
But yeah, you wouldn't have like a realtor fee like you would have, when you're first buying your house, which traditionally like the seller would be paying, and that might be like 6% of the sale price. Did I miss any other questions?
Well, I did have one in the chat earlier, which was about
Sure.
the student loan forgiveness. I was just wondering if you knew or had any inkling of like if there's like an expiration date, I guess, of when you should have had the loan. So if they forgive loans in 2021, what happens to like the new grad students and the new, freshmen who just took out loans? Would theirs be forgiven too? Or does it have to be like, loans that were granted between, I don't know, before 2010 or something like that?
That's a great question. One I don't know the answer to. If I were forced to give an answer, and this is being recorded, so I'm always hesitant to do that. My assumption would be, though, that they're probably, as long as the loans were taken out prior to, if it goes through Congress, prior to it being passed by Congress, it would be covered. But I mean, there's nothing preventing, a congressman from inserting something that would say otherwise to that. Yeah, I think I know where you may be going. I mean, yeah, I mean, there could be some strategic strategy there, but yeah, that would be for a different presentation.
Okay.
Any other questions? Yeah, the other thing, especially for those of you who are, students or have a long time before graduating, I have this slide up here. I mean, time really is the biggest asset that you have, regardless of how much money you're going to make in your lifetime. You just have so many years of compounding. And when I was taking a calculus class in high school, my math teacher just took 10 minutes out to just show us, the importance of compounding and how saving a little bit every month at, age 18 can be so vital. So I do highly encourage people, to start doing something just to kind of get that behavior learned.
Hi, so if there's no more questions, I want to thank Dr. Mountain again for a great presentation and workshop and for answering all of the questions. We really appreciate it. And hopefully people can reach out to you if they have further questions. I think your first slide gave your email address, if I recall.
Yeah, I was looking for it at the end, but yeah, apparently I wasn't smart enough to put it there.
It's fine. Thank you so much. I really appreciate it, especially on behalf of everybody who participated.
Yeah, you're welcome. Hope everyone has a good rest of their day and a good weekend.
Yes, thank you. I am going to stop recording now.